Hello, everyone, and welcome back to the Peterson Institute for International Economics. We are very proud today to welcome Dr. Joachim Nagel, the president of the Deutsche Bundesbank, at our penultimate event of our 2023 Macro Week and a true highlight. We have been fortunate to have a number of his predecessors and colleagues from the European Central Bank Governing Council speak here, but today is our first time having Dr. Nagel, and I'm very grateful to him for making time in his schedule to join us here at the Peterson Institute. He will be discussing appropriately, both given the times and given the institution, bringing inflation under control in turbulent times, something that the Bundesbank has done repeatedly through the years. If I may be allowed a brief personal note, I got to visit the Bundesbank for the first time as an intern in October 1992. I didn't meet the future president then, although I met some people, but it was coming up to the Bundesbank in 1992, immediately following the ERM crisis. One was approaching the font of stability in monetary and otherwise in Europe. And later on, when I got to work with Bernanke, Laubach, and Mishkin on inflation targeting, the Bundesbank's more flexible discipline than people realized played a big role in our thinking. And so obviously through to today, the president of the Deutsche Bundesbank and the institution plays a huge role in European and global monetary and financial policy. Dr. Joachim Nagel is a German economist, and he was appointed as president of the Deutsche Bundesbank in January 1 of last year. He is, of course, therefore a member of the Governing Council of the European Central Bank. Previously, he was deputy head of the banking department at the Bank for International Settlements, had an exposure in the private sector on the supervisory board of Deutsche Börse AG, a member of the executive council of the KfW group, the Kreditanstalt für Wiederaufbau, once upon a time, and prior to that had been a board member of the Deutsche Bundesbank from 2010 to 2016. He received his PhD in economics from the Karlsruhe Institute of Technology in 1991. Again, I hope this is the first of what will in future be additional visits to the Peterson Institute. We look forward to working with President Nagel and the staff, but now we look forward to his remarks. Thank you.
Ladies and gentlemen, dear Adam, thank you very much for your kind introduction. It is a real pleasure for me to be with you here at the Peterson Institute for International Economics in Washington, D.C. Thank you so much for the invitation, Adam. And I just learned that you have a longer tradition with the Bundesbank than I have this tradition, because I started my career in the Bundesbank in 1999. But I know that we met the first time the following year. So we have a tradition, we both, of 23 years. So thank you so much again being here in Washington, D.C. Let me give you my understanding about the challenges we have to deal with and what happened over the last 5 weeks, and what is my outlook, what is coming next. So you have to listen to me maybe the next 20 minutes. Over the last couple of days at the spring meetings, we have intensively debated current events in economics and finance. I'm now looking forward to sharing and discussing my views with you. The current economic policy debate is somewhat similar to the stage comeback of actors we haven't seen in a long time, and who had already been forgotten by some. Inflation is the one actor we had not seen in a long time. Obituaries to the supposedly deceased had already been written too early. The other actor who recently returned to the scene after a lengthy absence is financial turmoil. I hope it's just a cameo. Inflation is more or less back on stage. Inflation had been persistently low for many years, but over the last 1.5 years, it has reached rates not seen in decades. In the euro area, the so-called harmonized index of consumer prices rose on an average by 8.4 compared to 2021. Never before in the history of a single currency was inflation in the euro area as high as in 2022. For several months, we even recorded double-digit figures. However, high inflation has not been a euro area-specific problem, but a global issue. According to the IMF, consumer prices in the advanced economies rose in 2022 by 7.3%. That was the highest increase in 4 decades. First, disruptions in the supply chain and the wave of demand for goods during the pandemic led to supply bottlenecks. Initially, many assumed that these were transitory. Over time, however, it became increasingly apparent that inflation could remain high for longer than expected. Russia's terrible war of aggression against Ukraine and the resulting energy and food crisis then accelerated the rise in inflation significantly, especially in the euro area as a whole and in Germany, which had become overly dependent on Russian gas. Energy and food prices rose sharply, pushing euro area headline inflation into double-digit territory. While the headline rate has since returned to single digits, underlying inflation is constantly becoming broader and inflation is increasingly demand-driven. Core inflation, as measured by the harmonized consumer price index, excluding energy and food, has risen to 5.7% in March. This was the highest figure ever and the fourth record high. On the topic of core inflation, central bankers are sometimes asked pointedly whether they neither eat nor heat. But rest assured, they do both. Of course, the ECB does not target core inflation. Its 2% target relates to the headline rate of inflation. But looking only at the current headline rate could cause us to jump to conclusions. Core inflation measures provide valuable information about the underlying inflation trend, as they separate signals from noise. They hint at where headline inflation will settle in the medium term. And therefore, it is advisable to pay attention to core inflation. When it became evident that the inflation surge was more persistent than initially thought, policymakers reacted decisively. After several years of ultra-loose monetary policy, the ECB Governing Council changed its course radically. We stopped purchasing additional assets. In the space of just 8 months, we increased policy rates by 350 basis points. The relevant policy rate, which currently is the deposit facility rate, is now at 3%. We created the Transmission Protection Instrument, TPI, an instrument to support the effective transmission of monetary policy. And on top of that, we had started to shrink our balance sheet. Last month, we stopped fully reinvesting maturing securities bought under the Asset Purchase Program, APP. From March until June, this will lead to an initial decline in our APP portfolio by 15 billion per month. It is clear that the monetary policy measures still have some way to go for their full effect on inflation to unfold. To give you an idea, about a month ago, we estimated the extent to which the current tightening is already being reflected in some key variables. While we can assume that the measures have been passed through in full to money and capital markets, the estimated share for loan rates is roughly around 80%. Regarding the loan volume, the degree of pass-through is about 40%, while pass-through to GDP is around 30%, and to inflation, roughly 20%. Thus, the major part of the impact on inflation is still in the pipeline. Nevertheless, inflation in the euro area has receded somewhat over the past few months. But the battle for price stability has not yet been won. In March, the euro area consumer price index rose by 6.9%. The recent decline is mainly attributable to lower energy prices and favorable base effects. According to the latest ECB staff projections, inflation is expected to continue to decrease, but gradually. This also takes into account that the effects of monetary policy measures have not yet unfolded fully. For this year, the experts forecast inflation to average 5.3%. In 2024, they expect 2.9%, and only in the second half of 2025 is inflation projected to return to 2%. 2% is our medium-term inflation target. The inflation rate, excluding energy and food, is projected to remain above 2% until the end of 2025. As a caveat, the projection exercise was finalized before the recent market turmoil. But the latest World Economic Outlook released just this week forecast the same inflation figures for 2023 and 2024. Nevertheless, I believe that risks to price stability are currently tilted to the upside. On that note, it is not a given that we will return to price stability over the medium term. Therefore, I do not think that our job is already or even mostly done. Rather, in my opinion, further interest rate hikes will be required. Other critics warn that a further tightening would harm the economy or place too much strain on financial markets. Both arguments need to be taken seriously. Yet I find neither of them convincing. As regards the economy, monetary tightening has so far caused no serious harm in the euro area. Of course, it is undeniable that restoring price stability will require aggregate supply and demand to be aligned. And indeed, monetary tightening has been having a dampening effect on demand, an intended effect to be clear. But this will not necessarily lead to a recession. On the contrary, I'm rather confident that we can avoid a hard landing. The ECB projection for growth in 2023 has been revised up to an average of 1%. Economic activity will benefit from the decline in energy prices. And in 2024 and 2025, ECB staff experts that the ECB staff expect growth to pick up further to 1.6%. The euro area labor market is robust. The unemployment rate is at an all-time low, and the shortage of skilled labor is still very pronounced. Hence, the risk of choking off the economy by tightening monetary conditions is rather limited. In fact, it would harm the economy more if high inflation were to persist. In other words, if inflation is stubborn, we will just have to be even more stubborn. The second argument put forward against further rate hikes concerns financial stability. Some argue that the sharp increase in interest rates triggered the recent financial turmoil. If central banks were to tighten even more, so the argument goes, this would pose a threat to financial stability. While it is true that the rapid sequence of rate hikes has been a challenge for individual banks, it is a manageable risk. Over the medium term, commercial banks even benefit from higher interest rates since they can widen their margins again. These having been compressed during the era of negative rates. In this respect, I do not see the specific problems of individual banks such as Silicon Valley Bank or Credit Suisse as a symptom of a systemic crisis. The financial system as a whole has so far weathered the market turmoil. This is not to deny that decisive policy actions were necessary to contain its impact, and that recent events have certainly highlighted risks within the financial sector. In particular, we have seen that risks can materialize from the interplay of, first, excessive maturity transformation, a sudden materialization of high unrealized losses, low liquidity buffers, a high share of uninsured deposit concentrated in the tech sector, and last but not least, the combination of social media, digital finance tools, and nervous depositors. Now the question arises as to whether we need to adjust the framework for global financial regulation. In my view, it is now all the more important to implement the Basel III rules globally without any concessions. During the long period of very low interest rates, vulnerabilities in the financial system built up. For Europe and especially Germany, I can say that the regulators have responded to that. Examples of our response include the introduction of additional bank-specific capital surcharges or macroprudential capital buffers. Recent events have also shown that we should examine the impact of social media and social traders on financial markets. After all, some consider Silicon Valley Bank the first social media bank run in history, fueled in particular by tweets. The interesting question is how we can prevent short messages from having such devastating effects. There are also claims that single name CDS on certain banks might have caused market reactions. But the jury is still out on this. Single name CDS are derivatives based on the credit risk of a single borrower. There is a lot of over-the-counter trading in this market segment, which is based on remarkably low liquidity. In any case, we should explore how the liquidity and transparency of CDS markets can be improved. Effective market abuse supervision and extended reporting obligations would be essential. This would contribute to ensuring that market participants have confidence in the integrity and reliability of financial markets, even in times of stress. At any rate, our monetary policy toolkit is fully equipped to support the euro area financial system with liquidity if necessary. We are monitoring the situation carefully and stand ready to act. The euro area banking system is resilient. It is well capitalized and liquid. At the same time, in times of market turmoil, decisions need to be weighed particularly carefully. This makes it all the more important for us not to be locked into a preset course of action and to make monetary policy decisions based on incoming data, meeting by meeting. In the run-up to our next meeting, we need to assess whether the recent turmoil has led to an excessive tightening of credit conditions. If so, it could have an impact on our policy stance. But please don't get me wrong. The monetary policy stance is not the instrument of choice for addressing financial stability issues. The primary objective of the ECB monetary policy is to maintain price stability. And this target has definitely not yet been achieved. So if the baseline of our projection prevails, we have a lot more ground to cover, as Christine Lagarde rightly said. In other words, unless the inflation outlook improves significantly, expect us to raise interest rates further. We are not pre-committed to future rate hikes, but we are committed for delivering price stability. Thus, it is certainly far too early to stop raising rates and even think about lowering them. To get inflation under control, we need to reach sufficiently high and restrictive interest rate level. And we need to maintain that level for a sufficient period of time until the data and projections provide us with sufficient evidence that inflation is returning to our medium-term target of 2%. And this must also be reflected in underlying inflation. Otherwise, high inflation may become entrenched and inflation expectations might become unanchored. The longer the inflation shock persists, the higher the risk that this experience will leave scars in people's memories. In a speech I gave last year, I discussed such scarring effects in a little more detail. I pointed to recent studies which find evidence of this. For the United States, for example, a study has shown that people over the age of 60 have had higher inflation expectations over the past decade than younger people. They had obviously experienced the high inflation rates in the 1970s and early 80s, which has left its mark. My teenage children and their peers are currently experiencing high inflation for the first time in their life. The longer we have to live with inflation rates far above target, the greater the mark that this will leave. And this is not just a matter of memory. It has an impact on economic behavior. It may influence their expectations and decisions long after inflation has gone back down. High inflation is currently giving our central bankers a great deal of public attention. My colleagues and I would really enjoy it if inflation were so low that people would pay less attention to it. If inflation is sufficiently low, it is rational for consumers to be relatively inattentive to it. A recent study which looks at Google searches for inflation has found that different countries have different thresholds below which the population is inattentive to inflation. In most countries of the euro area, this threshold is somewhere between 2% and 3%. In other words, if the inflation rate is above this threshold, attention to inflation is increasing, and there are concerns about inflation. If people are aware of higher inflation and adjust their expectations accordingly, this can increase inflation itself. A further increase and entrenchment of the high inflation rate may follow. Of course, the accuracy of such estimates should not be overestimated. Nevertheless, the ECB's 2% target provides a safety margin to ensure that the threshold for increased attention is undershot, which is just one of the several good reasons why we should return to our target as soon as possible. Thank you very much.
Thank you very much, President Nagel. I found very striking your closing remarks about the scarring effect of inflation in the psyche and in economic behavior. That something coming from a German and a European is important to hear. Before you have to go running off to get back to Frankfurt, if we could, we'd like to pose a few questions. Let's start, if we could, with the big picture on inflation. You're coming out of G7, G20 meetings, talking with your colleagues. How different should we think about the inflation process outcomes in Europe and US, or Euro area and US? Is it part of one global phenomenon? Is it the same inflation? Is it very different because you have energy shocks much more than us? How should we think about that?
So my picture here is, thank you very much, Adam, for this very important question. I think, first of all, I guess this is not new, that the root cause for inflation in Europe and in the US is different. I think in the US it was more a demand-driven development, and on the European side it was more, or it was definitely driven by this supply shock. Started with this unprovoked war of aggression on the 24th of February of Russia against Ukraine. But I have to say that before the 24th of February, it was already clear that after the pandemic, inflation was more persistent than we thought. But with that war last year, this further escalation that brought inflation up to more than or close to 9% on average for last year. I think you already alluded to the IMF spring meeting. I think the inflation picture, despite the fact that the reason why inflation was or is as high as it was in the US or in Europe is different. I think the inflation pattern is not so different in the way we should bring inflation down. I think the Fed started earlier by hiking rates, the Eurosystem a little bit later. Headline inflation in the US came down a little bit earlier compared to the Eurosystem. And the same, this is my understanding here, will be with the core inflation. Core inflation is still very sticky in Europe, seems to be very stubborn, but my expectation is that before summer, we will also see that core inflation is coming down.
I have to digress and say, to me, the best line from your speech was, I believe, if inflation is stubborn, we'll be more stubborn, or something to that effect.
I do have to admit, I guess this is one of the sentences I created.
Good, good. Your speech writing team may be out of a job.
It was not chat. No, it was not something that was made artificial. So it was.
No, it's a perfect Bundesbank statement. But so sorry to keep shifting back and forth. But so back on the substance. I mean, as you said, your view is that the same disinflationary monetary policy is necessary, both U.S. and Europe. Mm. So the Governing Council has raised rates higher than you were forecasting a year ago. Is this primarily the result of the supply shocks? Because on the other hand, canonical inflation targeting is you're supposed to look through the first round of supply shocks. Is this demand? Why the increase?
I think, Adam, if you take the heterogeneity of the Eurosystem, I think on average inflation was above 8% for the whole Eurosystem, but there were countries like the Baltic countries where we had numbers above 20%. Just to give you a little bit an understanding that it was clear at a certain point to everyone in the Governing Council that inflation is much too high. This is our mandate. This is our job. We have to bring inflation to our medium-term target back to 2%. And I'm pretty proud that the Eurosystem, the whole Governing Council, developed a joint understanding what is necessary to bring inflation down. And it's right, we did 6 rate hikes, and I expect also for the May meeting that there's another rate hike. I will not speculate. Is that 25 or is it 50 basis points? Because it's important after the events of the last 5 weeks to really find out what might be the impact out of that development. And so it's good to have this meeting-to-meeting approach dependent on the new data we will have in May, or learning a little bit better what is maybe the impact on our, let me say, what does that mean to our interest rate transmission channel, right, and what is the impact out of that? And so I believe this is the best way to deal with a situation like that.
Could we turn, thank you, President. Could we turn for a moment to Germany specifically? Mm. For some years now, well before the Russians' aggression on Ukraine, well before COVID, the German labor market has seemingly been performing very well. You're reaching levels of participation and low levels of unemployment that many had thought were not going to be attainable. There are questions about, given that tight labor market, how much of the current inflation is being passed through. You've talked about this a bit in your speech. My sense was, reading the newspapers, that Ige Shemi, for example, took a pretty restrained approach to wage increases, but that Verdi seems to be taking a more aggressive approach. Obviously, you're not going to comment on specific union tariff on the wage bargains, but what should we know about the German labor market and the extent of catch-up wages in Germany in this circumstance?
I think, first of all, the labor market is still very strong. It's very robust, close to full employment. And yes, we have to wait what will be the outcome, the final outcome, if all the wage negotiations are more or less done and being settled. It looks like that the wages will be, the wage increase will be above what we had over the, let me say, past 15 years, more or less. And we also should realize that the wages were in real negative territory over a couple of years. So I have a good understanding why the unions, when inflation is so high, ask for higher wages. And but on the other side, you alluded already to that. I do not see, and I put it a little bit in a different order. I do not see that there is a price-wage spiral, because it started on the price front. We had this supply shock, this energy price shock, and it is not already. It's not helpful for us at the end when maybe wages are above 5 or 6%, but they are not harmful in the way that we shouldn't. That it might reduce our capability to bring inflation down. So I'm rather optimistic, and I have a lot of trust what the unions and the companies might agree on. And over the past years, I think Germany was also famous for its wage moderation.
Right.
And so I have a lot of trust that this wage moderation also works this year and in the future.
Thank you. Prior to the SVB and Credit Suisse and other messes, one topic of discussion in markets and central banking was the seeming puzzle of monetary policy transmission. In other words, that in the US context, the Fed had raised rates by 450 basis points in a very short amount of time, and the labor market remains tight. Not that much seemed to be happening. We'll come back to the issue of financial stability, but similarly, one cannot say Germany's unscathed, but a lot of that has to do with the Russian aggression on energy as well. Where is your thinking about monetary transmission now in the euro area? I mean, do you think it's been attenuated? It takes longer than it used to? Is it the same? Was this all special circumstance?
So if we take, for example, what we are doing on the Bundesbank side in our bank lending survey, it seems to be that the transmission process is not so different from what we know from the past. So, and I alluded to that in my speech, that we see that we see the effects of what we did over the last eight months when we started to raise interest rates. So, but maybe the difference is that the economic environment is so different. The labor market behavior is different from, let me say, past hike cycles. So this is something we have to. This is something new that we have to deal with. That we have to deal with that. Then you already mentioned what went on the financial stability side. I have the clear view that there is not a contradiction between what we have to do on the monetary policy side and what is maybe necessary on the financial stability side, because we have different instruments that makes it more or less possible that we can tackle price stability issues different from the financial stability issues. So I was convinced that in our last meeting it was so important to have this 50 basis points hike in a situation where where uncertainty was very high, but it was a clear signal to the market participants that we do this differentiation, or this, we can separate what we have to do on the price stability side and what is maybe necessary on the financial stability side.
This is really important. The ECB has been sort of a leader, I shouldn't say sort of, has been a leader in putting into practice this separation principle as a central bank, that there's macroprudential or financial stability tools, there's monetary policy tools. Maybe I can ask you to expand a bit on that. So if, God forbid, the American mismanagement of our banking system blows up further, or something.
This is something you just said.
Yeah, I'll say that. I mean, no, that's me. I'm not an official. I'm allowed to say things like that. If some financial shock comes, is the optimal response then that the ECB will implement more LTROs or other bank measures while continuing to hike rates? Is the discussion about calibrating the two? I mean, just sort of in practice, how does the separation principle work?
I think, first of all, Adam, it depends on the type of the shock, but taking the experience of the, let me say, past 10 years, I think the Eurosystem showed its capability to create new instruments, being very flexible. So we did a lot over the last 10 years. I think we created a lot of excess liquidity. Now we are starting to bring this excess liquidity down. But as I said, we have all the instruments. We have the toolbox that makes it more or less possible to tackle all these things. So this is something we showed on the price stability side in a situation where inflation was too low, and now we showed the same commitment when inflation is too high. I have the personal belief that on the asset side, regarding our asset portfolio, we could do even more. So I hope that we could come in June to a conclusion that we reduce our asset portfolio more than 15 billion on a monthly basis. But again, it gives me the chance to say, well, all what might happen on the financial stability side, we also did a lot over the last 10 years in Europe. I think the banks are much better off, better capitalized, better liquidity situation. And I said this during our meetings over the last 3 days several times. I think the first line of defense is Basel III. The implementation of the full scope of Basel III is the first line of defense. And that would be an important step forward, that all countries, for all banks, should more or less implement Basel III, the full scope. But I have also to say, Adam, that there are still some blind spots. And the last 5 weeks should serve as a kind of an eye-opener to us. We shouldn't be complacent. We should ask ourselves, is the way we are regulating banks, the whole financial system, is that the right way? Does it serve more or less for all the challenges that we are confronted with? And I believe it is maybe not the case. So my point here is we have to really stress our regulatory framework. This is something of utmost importance to me, and would be more or less, would not be right not to take the right lessons out of the events over the last 5 weeks. But this is not a financial crisis.
Right.
I went through a financial crisis. I had to manage, for example, for the Eurosystem, the Lehman portfolio. So I know really what a financial crisis makes it different from what we saw in the past couple of weeks. These are idiosyncratic cases. The reasons why they happened because of so many different reasons. So I believe it's really, we have to look in that, but taking the right lessons for our regulatory framework.
Thank you for the very fulsome response on that. And I know from your background you were ready to speak on that issue. Thank you. Turning back more in a monetary policy direction. Oftentimes, including here at Peterson, some of the macro trends are discussed and summarized in thinking about R star, which is of course unobservable, doesn't really exist, but nonetheless seems to be a useful heuristic. The IMF recently published, I don't know if it was a blog or a paper, but basically saying we expect interest rates to long-term interest rates after the disinflation to go back down to roughly where they were pre-COVID. Our colleague here at Peterson, Olivier Blanchard, made a similar argument a couple months back. Our vice chair of our board, Larry Summers, has come out since January and said in a couple places, including here, no, R-star is going to stay up. Do you have an opinion on this? And is the euro area R-star tied to the global or the US R-star, or is there separate concepts?
Yeah, this is one of these, let's say, questions. It's difficult to answer. What we did on the Bundesbank side, we did some calculations regarding R-star. It's clear that R-star came down over the past 15 years. This is for sure. What we see for R-star, for the Europe system, it fluctuates around 0. So, and it's below R-star compared to the United States. We can ask ourselves, where are maybe the reasons? Is it maybe the aging of the society? We could discuss that, but I believe that R-star will stay on these low levels. It will not go up significantly. The greening of the economy, the transformation process, all these things might more or less also playing a role here. We all know the pros and the cons of the R-star calculation, but there is a differentiation. There are differences between the US and Europe. What we can see that the level is indeed different. This is for sure.
Thank you. We're about out of time, and we're very grateful for your time this week of always, President Nagel. But let me, if I could, ask one more question, since you just mentioned the greening of the economy. In various meetings, official and some others that you and I both attended, we've started hearing the discussion of how monetary policy regimes might have to change in the green transition. So, I mean, there's debate about the role of central banks in this on the financial side, but I'm asking really on the monetary side. If we start having as we should, and as Europe does, a trend rise in carbon price, or we start having, as seems plausible, recurrent energy price shocks, does this change the kind of monetary policy making that needs to be undertaken? So, for example, I'm not trying to put words in your mouth, I'm just trying to buy you time. For example, does this change the textbook that you let the supply shock go through first round?
I think, let me start maybe before this crisis started. I think on the Bundesbank side, we did some calculation. What does that mean for inflation, the transformation of the whole economy? So we came to a range of 0.3 up to 1.1 percentage points on top of the inflation rate. So it comes with a challenge. Transformation of an economy has a price effect, this is for sure. So it makes the job for central banks definitely not easier, but we believe it is an important transformation. So this is the first point. The second point, central banks can do a lot to more or less align this whole, let me say, challenge, but we are not in the driver's seat. This is for sure. I think our mandate, our core mandate is price stability. We can do something on our collateral side. We can incentivize banks to do more on the sustainability side. We can do something on the banking supervision side. But it is clear that this is a political responsibility, first of all. Now coming back to what does that mean for monetary policy, it will be part of our future considerations, discussions, how to deal with that. Is that something that is a game changer for the central banks? I don't believe so. It makes maybe the job a little bit more challenging, but I think we know what we have to do when inflation is going up. We do know which instruments we do have, and this is not changing too much in a situation where an economy is being transformed to a more sustainable economy.
Thank you. On that positive note of conviction about the role of central banks, we will now close this meeting. We're very proud and honored to have had Dr. Joachim Nagel, the president of the Deutsche Bundesbank and member of the European Central Bank Governing Council, with us today. We will close out PIIE Macro Week tomorrow with the governor's colleague, the president's colleague, Governor Yi Gang of the People's Bank of China. But this was truly a highlight for us to have you here. Thank you very much.
Thank you very much.